Hey guys, Richard Matthews here with Matthews Wealth Management. Today we want to talk about loss and recovery and what that actually looks like. We've had a really rough go here in the first quarter of 2020 as far as the market drop. So I want to talk about what that actually means and how we can get positioned to bounce back. So first thing, let's understand what the problem is. Let's go through some examples of what kind of loss we take on and what kind of need it takes as far as a bounce back return to get back to where we started. So quick scenario here. Let's say that we're starting with $100. So we've got $100, we're going to lose 10%, a market downturn, market correction. 10% of $100 or $100,000, doesn't really matter, is going to be $10. So now we're left with 90, okay? So if we're at 90 after a market drop, what does it take to get back to the 100 we started with? Well, most people would say 10%. So if we add the 10% back into it, 10% of 90 is not $10, it's actually $9. So we're back to 99. So our estimate of 10% to get back to where we started is a little bit low. The actual answer is 11.111%, and it goes on forever for that fraction. But as this starts to increase, how much we lose, that amount that needs to recover is exponentially more. So I just want to run through what those numbers look like to give everybody an understanding of what the problem is when we take on loss. So the first thing, we just went through this one. We lose 10%. It's going to take us 11% to get back to where we started. Let's say that we lose 15%. It's going to take us 18% roughly to get back to where we started. Let's say we lose 25%. That's kind of where we are right now in the end of the first quarter. It's going to take 33% to get back to where we started before this whole market downturn. And then the last one, which is the most intuitive, let's say that you lost half, 50%. Some people may have done this in the dot-com or the real estate bubble when they burst. Obviously, this makes sense. You lose half of your money, you got to double your money to get back. 100%. So this illustrates the real issue of what we're facing. When we take on a loss, it's not just making money, we have to make up that much more in terms of the percentage on a much smaller balance. So next we're going to come back and talk to you a little bit about gains and growth and how to actually get back out of that hole. Hey guys, we're back. We were talking about losses in the last segment. Now we're going to talk about gains and why it matters to maximize as much as we can in the upside efficiency of a market rebound. So what we've got up here is we've got two different portfolios that are generating different rates of return. Portfolio 1 here is generating a 4.5% rate of return, which typically when we have a market downturn, a lot of investors start moving to something more conservative. Just because of what the roller coaster ride feels like on the way down, they want to feel something a little bit more safe in the downturn, and it affects them on the way back up. However, Portfolio 2 here, we're going to look at what just 1% more a year in terms of rebound and ongoing would create in terms of a difference between the two portfolios. So what we've got is, over the years, I'm skipping from 1 to 5 year, 10 year, 15, and 20. And so Portfolio 1 and Portfolio 2 are going to start with $500,000. So let's see how that works out. So now we've got the year 5. Portfolio 1 is at $623,000. Portfolio 2 is at $653,000. Just from 1% difference. That 1%, by the way, can come from investing efficiency. It can come from minimizing fees that you're paying for like a mutual fund or ETFs or even an advisor fee. So it's important that we look at where we can source this extra 1%, but let's just say efficiency right now. That's a difference of $30,000 that Portfolio 1 is missing out on in just 5 years. So if we fast forward another 5 years, Portfolio 1 is at $776,000. Portfolio 2 is at $854,000. That's $77,000 in 10 years that now Portfolio 1 is missed out on by not having that last 1% rate of return. So if we fast forward to 15, we're straddling the $1 million mark. 150 grand is the difference. And by the time we get all the way to 20 years, it's $253,000 that Portfolio 1 missed out on, that Portfolio 2 got because they had that extra 1% efficiency. If you compare that 20-year number to what we started out with, that's more than 50% of our original balance. So 1% a year does matter. It's very important we position right now to take advantage of those opportunities. We'll be right back. All right, guys, we're back. We're going to put the two segments together, how to minimize the loss and why that matters, as well as getting that little bit of efficiency out of a rebound. So we've got two different portfolios here that we're going to take a look at. Portfolio A is going to be the typical retail investment allocation. So if you're working with a financial advisor that gave you a phone call or that you met through a friend, and they gave you the risk tolerance questionnaire and put you into one of the pie charts based on your risk, this is kind of typical of what we would see of one of those types. Under the fiduciary side, this is customized investment allocations and investment management. So we have a higher degree of efficiency. So let's look at, if we start with $100,000, what that's going to do over a hypothetical downturn over a 5-year period of time. So first area we're going to look at, year one, we have the retail account, and it takes on a nearly 21% loss in the first year. So this is kind of where we are now with our downturn, our bear market that we've seen in the first quarter. So that retail account may look like $79,000 at this point. Conversely, what we're going to say is that we see a fiduciary number of a -13. This actually represents my entire practice right now. As an average, we're down 13% in the first quarter. So by comparison, 79 versus the 86,000. So in theory, we're ahead of the retail by nearly 8%. So if we then take from our second segment, the 4.5% versus a 5.5% portfolio, just for that extra percent of efficiency, we can see how the 79,000 grows over the coming years, and then how the 86,000 grows over the coming years. So let's just go through year two. We're at 82,500. Year three, we're at 86,313. And one thing I want to point out, if you'll notice, 86,313 hasn't even caught up to where we initially were on minimizing our downturn. That's why it's important to continue to protect on the downside capture. We want to minimize our actual risk of taking on that loss. Finally, we get past year one of the efficient portfolio, and we're at 90, and we end at 94. We're still not where we came from when it comes from the 100,000, still in the hole because of how much we lost in year one. Now let's look at the rest of the efficient portfolio. Second year, we're at the 5.5 as opposed to the 4.5, and that's 91,000. Then we get to 96, and hey, we're already back to where we started in this hypothetical in the middle of the third year. Then we hit the 102, and we finish with 107. And obviously this speaks volumes for the difference between money management, downside capture, and eking out that little bit of efficiency. Join us next time. Can't wait to see you.